In Japan, there is an old saying that the bamboo which bends is stronger than the oak that resists. And this simple observation captures the core philosophy behind how Japan approaches not only life and nature, but also business, economics, and investing. Because while much of the modern world is obsessed with speed, immediate results, and constant reaction, Japanese thinking has always emphasized endurance, continuity, and survival over excitement. And nowhere is this difference more visible than in the way Japan invests. Because Japanese investors do not ask how fast they can make money. They ask whether a decision can survive decades of uncertainty, crises, and change. And this mindset stands in sharp contrast to global markets driven by quarterly earnings, breaking news, and emotional speculation. As Japan has chosen a slower, quieter path where discipline replaces impulse and patience replaces fear. And this approach is not accidental, but deeply rooted in culture, history, and experience, shaped by centuries of natural disasters, economic shocks, and social rebuilding, which taught Japan a hard lesson early on. What survives is not what grows fastest, but what adapts and endures. And this belief flows directly into investing, where continuity is valued above speed and resilience is valued above brilliance. Meaning Japanese investors are not impressed by rapid gains or flashy trends, but by stability, reliability, and usefulness over time. Because many Japanese companies are not built to dominate headlines for a year or two, but to serve society for generations. And this is not metaphorical language, as Japan has more companies older than 100 years than any other country on Earth, including businesses that have survived wars, recessions, currency collapses, and technological revolutions simply by focusing on doing one thing well, consistently, and responsibly. And when companies think in generations, investors naturally follow the same logic, shifting their attention away from speculation and towards sustainability, which is why Japanese investing culture begins not with profit targets but with purpose, asking whether a business is necessary, whether it solves a real problem, and whether it can continue to do so even when conditions worsen. Because in Japan, profit is not treated as the goal, but as the result of correct behavior sustained over time. An idea deeply influenced by traditional concepts such as shokunin kishitsu, the craftsman's spirit that values mastery and pride in work. Kasan, the philosophy of continuous incremental improvement rather than radical change. And Gaiman, the ability to endure hardship quietly without complaint. All of which shape an investor who understands that markets are inherently uncertain and cannot be controlled. But behavior can be disciplined, risk can be managed, and time can be used as an ally rather than an enemy, leading Japanese investors to accept a fundamental truth that many modern traders struggle with, which is that attempting to predict the future is less effective than preparing for it. And this preparation begins with a strict focus on avoiding permanent loss. Because in Japanese, investing the first and most important rule is not how much can be gained, but how much can be preserved. And this philosophy directly challenges the Western narrative that risk is inherently virtuous and that greater rewards always require greater danger. As Japanese investors treat risk with respect rather than romance, recognizing that some risks are unavoidable, but many are unnecessary, and so they design portfolios around capital preservation, stable cash flows, conservative leverage, and businesses with predictable demand, favoring companies that provide essential goods and services, maintain strong balance sheets, and operate with long-term strategic clarity, while deliberately avoiding excessive debt, speculative growth stories, and fashionable trends that rely more on narrative than fundamentals. Because Japanese investors would rather earn modest but reliable returns over long periods than gamble on high returns that expose them to catastrophic loss, fully understanding that compounding only works when capital survives, and that losing money permanently destroys not just wealth, but time itself. Which is why boredom is often embraced rather than feared, as boring investments are usually stable investments, and stability allows time to perform its quiet work, turning small, consistent gains into substantial wealth over decades. And time, in Japanese investing, is treated as the most valuable asset of all, not to be rushed, manipulated, or wasted, but respected and allowed to operate naturally. A perspective reinforced by Japan's broader social and economic structure, where long-term employment, lifetime customer relationships, and multi-decade planning are common. And this respect for time manifests in low portfolio turnover, minimal trading activity, and a disciplined focus on reinvesting dividends and holding assets through market cycles. Because Japanese investors do not feel compelled to act simply because prices move. Instead, they act only when the underlying reason for an investment has changed, asking not whether the market is volatile today, but whether the company's purpose, competitive advantage, or financial integrity has deteriorated, and if the answer is no, they remain patient. Understanding that inactivity, when guided by conviction and analysis, is often more powerful than constant action. And this calm approach is further reinforced by the dominant role of institutions within Japan's financial system, including pension funds, insurance companies, and long-term savings vehicles that manage capital across generations rather than years. Most notably, the Government Pension Investment Fund of Japan, one of the largest institutional investors in the world, whose mandate emphasizes diversification, risk management, and long-term stability rather than chasing short-term performance. And when such institutions set the tone for the market, they reduce volatility, absorb shocks, and normalize patience, creating an environment where disciplined investors are rewarded and emotional speculation is quietly punished, making it difficult for hype-driven strategies to dominate for long, which explains why Japanese markets often appear calm or even stagnant to outside observers, while internally they function as systems designed to endure rather than impress. And this endurance-based culture also explains why Japanese investors deliberately distance themselves from noise. Not because they are uninformed, but because they are selective in what they consider relevant, choosing to focus on fundamentals such as earnings quality, cash flow, consistency, competitive positioning, governance standards, and long-term industry relevance, while filtering out daily headlines, social media speculation, and emotionally charged narratives that add stress but little value. Because in the Japanese way of investing, clarity comes from simplicity, discipline comes from restraint, and strength comes from silence. And this philosophy does not promise rapid wealth or dramatic success stories, but it offers something far more powerful: the ability to survive uncertainty, protect capital, and quietly build prosperity over time. Which is why the Japanese way of investing may appear slow to the impatient conservative, to the reckless and boring to the thrill seeker. But history shows that it is precisely this combination of patience, discipline, and long-term thinking that transforms time into profit, stability into strength, and silence into enduring wealth. When we move from philosophy to practice, the Japanese way of investing becomes even clearer. Because behind the calm mindset and long-term thinking lies a very concrete and methodical approach to capital allocation, portfolio construction, and decision-making. One that is designed not to outperform the market in a single year, but to survive and grow through multiple economic cycles, including recessions, bubbles, technological disruptions, and geopolitical shocks. And this practical discipline begins with how Japanese investors choose assets, as they rarely start with price and instead begin with function, asking what role an investment plays within a broader system, whether it provides stability, income protection, or gradual growth. And this systems-based thinking means portfolios are not built around excitement but balance, where different assets serve different purposes and no single investment is expected to do everything. Which is why Japanese portfolios often combine stable domestic equities, global diversification, bonds, cash reserves, and real assets in proportions that change slowly over time rather than reacting to every market fluctuation. Because the goal is not to predict which asset will perform best next year, but to ensure that portfolio remains functional under many possible futures. A mindset shaped by Japan's long experience with uncertainty, deflation, and low-growth environments, which taught investors that survival during difficult periods matters more than maximizing gains during favorable ones. And this is why Japanese investors place such a strong emphasis on downside protection, favoring companies with conservative balance sheets, strong cash positions, and resilient business models that can operate profitably even when demand weakens. Interest rates rise or costs increase, and in practice this means preferring firms with stable customer bases, diversified revenue streams, and a clear competitive edge that does not depend on constant innovation or aggressive expansion, as reliability is valued more than rapid growth. And this preference also explains why dividend-paying companies play an important role in Japanese investing. not because dividends are seen as free money, but because they represent discipline, profitability, and accountability. As a company that consistently pays dividends must generate real cash flow and manage capital responsibly. And for investors who think in decades, dividends provide not only income, but psychological stability, reducing the temptation to sell during market downturns and reinforcing the habit of reinvestment, which allows compounding to work quietly in the background. And this long-term reinvestment mindset is further supported by Japan's tax structures and savings culture, which encourage patience and discourage excessive trading, as frequent buying and selling is viewed not as skill, but as unnecessary friction that increases costs, taxes, and emotional stress. And this aversion to excessive trading is not accidental, but intentional, as Japanese investors understand that transaction costs, even when small, compound negatively over time, eroding returns in subtle but powerful ways, which is why low turnover and simplicity are considered strengths rather than weaknesses. And simplicity also extends to how Japanese investors analyze information, as they prefer clarity over complexity, focusing on a small number of understandable metrics rather than elaborate financial models, emphasizing cash flow, debt levels, return on invested capital, and long-term earning stability, because complexity often hides risk rather than reducing it. And this cautious approach to analysis reflects a broader cultural preference for reliability over brilliance, as Japanese investors are less impressed by visionary promises and more concerned with execution, governance, and consistency, which is why management quality matters greatly, with emphasis placed on leadership continuity, internal promotion, and alignment with long-term stakeholders rather than short-term incentives. And this alignment between management and investors is reinforced by Japan's corporate culture, where hostile takeovers are rare and long-term relationships between companies, banks, and shareholders remain common, creating an environment where cooperation is valued over confrontation and where companies are encouraged to prioritize sustainability rather than aggressive shareholder extraction. And while this system has been criticized for limiting short-term returns, it has also created a remarkable level of stability, allowing companies to invest through downturns, maintain employment, and preserve institutional knowledge, all of which ultimately support long-term profitability. And from an investor's perspective, this stability reduces uncertainty and allows for more confident long-term holding, as the risk of sudden strategic shifts or excessive leverage is lower, and this is particularly important during crises, when Japanese investors tend to behave differently from their global counterparts, as market downturns are not viewed as emergencies but as expected phases of a long journey. And rather than panicking, many Japanese investors use downturns as opportunities to rebalance gradually, adding to positions selectively while maintaining overall portfolio balance, avoiding aggressive bottom fishing or all-in bets, because discipline requires restraint even when prices appear attractive. And this restraint is one of the most difficult aspects of the Japanese approach for outsiders to adopt, as it requires resisting both fear during crashes and greed during rallies, maintaining a steady pace regardless of emotional pressure. And this emotional regulation is perhaps the most valuable yet least visible component of Japanese investing, as it is not taught through formulas but cultivated through habit, repetition, and cultural reinforcement, where patience is praised and impulsiveness is quietly discouraged. And this mindset extends beyond equities into other areas such as bonds, real estate, and savings, where leverage is used cautiously and liquidity is respected, with cash not viewed as wasted potential, but as optionality, providing flexibility and security in uncertain times. And this respect for liquidity has proven valuable during periods of crisis, allowing investors to meet obligations, seize opportunities, or simply endure without being forced into unfavorable decisions. And when viewed from the outside, this approach may appear overly conservative or inefficient, especially during periods of rapid global growth, but over full cycles it reveals its true strength as it minimizes catastrophic losses, smooths volatility, and allows wealth to compound steadily. And for individual investors outside Japan seeking to apply these principles, the lesson is not to copy Japanese markets or asset allocations directly, but to adopt the underlying mindset, beginning with the acceptance that investing is not a race, but a long process of disciplined decision-making, where success depends less on predicting the future and more on managing behavior, controlling risk, and allowing time to work. Which means setting realistic expectations, building portfolios that can survive multiple scenarios, avoiding unnecessary complexity, limiting leverage, reinvesting consistently, and resisting the urge to react to every piece of news, because the Japanese way of investing teaches that the greatest enemy of long-term wealth is not market volatility, but impatience, and that true profitability emerges not from bold predictions, but from quiet consistency, where small, correct actions repeated over long periods create results that appear unremarkable in the short term, but powerful in hindsight. And this is why Japanese investing rarely produces dramatic success stories overnight, but it produces something far more valuable: resilience, predictability, and peace of mind, allowing investors to sleep during market turmoil and remain confident in their strategy even when headlines suggest chaos. Because, in the end, the Japanese way of investing is not about beating the market, impressing others, or proving intelligence, but about aligning behavior with reality, respecting uncertainty, and building a system that continues to function regardless of external conditions. And in a world increasingly dominated by noise, speed, and emotional extremes, this quiet, disciplined, and patient approach may be the most radical investment strategy of all, offering not just financial returns, but stability, clarity, and control over one's long-term financial future.